like to welcome you again to our workshop, our webinar, and I would like to welcome Dave Wilkie, who is a wonderful supporter of the Small Business Development Center. He gives lots of different talks for us throughout the year, and if you're interested in learning more, I'm sure David will have his contact information at the end of this webinar. David?
Thank you, Christine, and thank you everyone for joining. First, if there's 60 people on the phone or if there is 600,000, my expectation is that the summary of this Tax Cuts and Jobs Act will impact everyone, whether it's a child, a retired individual, a business owner for sure, and any working American. So this Tax Cuts and Jobs Act is impactful for pretty much anyone in our country, and also for companies that are overseas that want to come back into the United States. Very significant changes. So we're going to focus on individuals and businesses today, and that is probably most likely our audience, and we'll leave room for questions. I want to cover a lot of things with regard to individuals first, and then we'll work our way towards business. The objectives I would have for everyone on the call is to hopefully walk away with some ideas and strategies that they would be able to implement throughout the year and throughout the next 4 years and longer if this Tax Act will stay in place for that long. We expect that it will certainly for the next 3 years and perhaps longer. So we're going to, with those objectives, having ideas and strategies, start with individual tax rates. Individual tax rates is our first major change. Quite significant is the drop in tax rates for somebody earning less than $315,000 of taxable income. And as you see in our slide, we have the tax rates posted. Now, one of the fun things that we as tax planners and tax preparers like to see is how somebody's income gets taxed, and we always look at the government as your partner and how much you're going to pay your partner. And when you pay your partner, you can pay them 37% according with the new law, or you can pay as low as 0 or 10% based on your income. What we'd like to suggest to everyone is that, especially in small business, is that your objective would be to stay within the 24% bracket. Generally, that would allow you earnings of $400,000 with tax deductions, still having itemized tax deductions and perhaps retirement plan contributions, getting your taxable income down to about $315,000. So if your taxable income is then $315,000 and your effective tax rate is your top tax to your tax rate is 24%, your effective rate could be as low as 18% and perhaps 20% if without a small business. But it could be even lower with certain small businesses and pass-throughs, as we'll learn later. What that means is that if your effective tax rate, which means the effective dollars you pay on all of your income, is about 20%, roughly your taxes are going to be about $60,000. When you take the $315,000 and subtract out your federal taxes of $60,000, what's going to happen is you're going to end up with about $255,000, not including state and local taxes, but about $250,000 of money that would be left over. Most Pennsylvania households are able to, fortunately, pay their bills on approximately $20,000 a month. So if you're spending more than $20,000 a month on your household expenses and your income is higher, there would be other strategies to perhaps employ, and those we'll get into the business side later. But if you're an individual and your household income is in these ranges, you would expect a significant tax decrease. We're suggesting that other people, you would take advantage of these tax decreases And if you can put additional tax dollars into your retirement accounts, you're going to get additional savings. So that if you're not maximizing your retirement plan contributions with your employer or within your small business, now with the additional cash available, your money could be contributed as retirement plan contributions and save an additional 24% in those brackets on the dollars contributed. So these are planning strategies as individuals that we would like to propose to the listeners that you walk away and plan for the remaining part of 2018 and subsequent years. So we will go, as you can see, at bare minimum, our tax brackets were at the highest rate, 39.6 in 2017, and now 37%. We'll learn about tax deductions next. And first is one very big note for everyone to recognize that the exemption amounts have increased for alternative minimum tax. The result of this is quite amazing, and we're very excited about the alternative minimum tax reductions. So that will, again, reduce taxes for most people significantly. And we're talking thousands of dollars for a lot of people that were in the AMT situation. And those alternative minimum taxes were very high for those in that $300,000 range of income. When we go to itemized deductions, I'm going to go to the one that most people don't like to talk about. That's the first one in our list, and that's the real estate and state and local sales or income taxes, and sales taxes. So these taxes, of all taxes that you're paying to your state and local government for real estate and income, are now aggregated to a maximum of $10,000 as an annual tax deduction. So the way I like to explain this is that if somebody is living in California and the income tax rate in the state of California is 10%, their tax for California would be up to $100,000. Their federal tax deduction, unfortunately, would only be $10,000. So that would create a large tax increase for that individual. However, recognize that their tax rate effectively has dropped from 39.6% to 37%, and also the brackets were expanded, so they are likely to save about 4% on their tax rates. However, they have lost a $90,000 tax deduction. Those numbers would equate to not much of a change in that individual's tax return. So that individual would not likely recognize a significant reduction in taxes at all, and perhaps some people will actually pay more taxes because of this limitation. However, for most people, certainly in Pennsylvania and for wage earners around the $300,000 to $400,000 range and under, the Tax Act will be quite amazing in their reduced taxes. So as we go through, that's one of the negatives, again, that we're dealing with. However, also what's very interesting to point out with regard to the last slide is the alternative minimum tax. That was calculated for most Pennsylvanians. We have seen that alternative minimum tax was increased because of increased real estate taxes and state and local income taxes. So that a lot of the savings that people recognized on this real estate tax and state and local income taxes were eliminated by alternative minimum tax. Both of those things have now been eliminated for most people, so that the alternative minimum tax won't apply, but you will not receive a tax deduction for these extra taxes. So the net change and of impact to many people for those two areas of the law will not have a major impact in the calculation. In other words, they should net together, and then you'll still be left with the tax rate changes, which are very significant, irregardless of the first limitation. So we spent some time on that, but I think it's a very important area of the law, and it's widely talked about and discussed. but when you map it out and you calculate it with tax calculators, you'll recognize that the impact is not as significant as many people think. Next is the phase out of deductions due to income limitations is repealed. So that means that somebody that was making $400,000 of income was losing a percentage of their itemized deductions. This is now repealed so that if you make charitable contributions, for example, of $50,000 on your $400,000 of income, you would be able to deduct that $50,000. That limit is increased now. It used to be 50% of your income. Now it's up to 60% of your income. So again, some complaints about the Tax Act have been that charities will receive less proceeds from individuals. However, some individuals may contribute more because the limit is now up to 60% of their income, what they can deduct. So there's some pros and cons to that side of the equation as well. The next line item is most miscellaneous itemized deductions subject to the 2% floor will no longer be allowed. This is quite significant for many people. Specifically, I hope sometimes I'll say things and I'll say them a few times. This is one I'd like to say about 18 times, but I'll say it twice. One, unreimbursed business expenses are no longer allowed. So unreimbursed business expenses are no longer allowed. What I'd suggest as a planning opportunity for anybody that's listening or anybody that wants to discuss it with others is that reimbursements by your employer, and if you are the employer, should now be expanded as a benefit to employees and to companies. For example, if somebody works at home and they use their internet access to access the office, however, they don't have a home office officially, which means regular and exclusive use of an area in their home. However, but they do use internet access. That internet access, it should be an allowable reimbursement by the company. However, if the company does not reimburse the employee for that home office use or that home use of their internet, then that internet fee is not deductible by the individual. This applies most significantly to traveling salespeople for their mileage deductions that used to be allowed on their personal tax returns and are no longer allowed. Neither are cell phone charges and any other business expenses that you would incur that are not reimbursed by your employer. Again, the planning opportunity here, and it's significant, is that employers and company owners would expand their reimbursement plans with employees to allow much greater reimbursement and perhaps use that in many ways to offset compensation and raises. You've heard of many stories in the news that employers are paying bonuses to employees. We're suggesting that at least talk to employees and discuss with your employer about expanding the reimbursements that you as an employee would receive. So sorry to spend, again, more time on that than maybe is necessary, but it's a very significant part of the Act, and I hope you'll walk away with at least that today. Limitations on mortgage interest. This is very important to recognize that home equity lines of credit are no longer tax deductible. So interest on home equity lines of credit are no longer tax deductible. If you know somebody in the mortgage business, my expectation is they are very busy and they're going to be hard to track down because a lot of people are going to take their home equity lines of credit and convert them into mortgages. This can be done, again, with a mortgage lender generally, and we would suggest as a planning opportunity, if you have a home equity loan, that you may consider combining that into your main mortgage and have a interest deduction. Now, if your mortgages are combined less than up to $750,000 or less, the interest would be tax deductible on your main home. However, if you had a mortgage debt up to $1 million in 2017, you would be allowed to continue to deduct that interest. That's a special area of the law. Not many people know this, that if it's called the grandfather rule on the mortgage, but you would be able to continue to deduct your mortgage interest even if you exceed the $750,000 mortgage limit. So there's some good things there to carry over, but also some very much a large change on these equity loans, and they should be reviewed as a planning opportunity with your mortgage lender. We talked about the next section, which is unreimbursed business expenses are no longer deductible. Again, I think that's quite significant. Please recognize that in your day-to-day activities for the rest of this year and as long as this act remains intact. The standard deduction is also something that is quite significant. And as you recognized in the State of the Union speech by President Trump, he mentioned that somebody, a married couple now making $24,000 in a year will not pay any income taxes. They have a 0% tax rate. This is because the standard deduction is now $24,000. And also, again, the rates are lower, so as you get up to the higher brackets, so you could really be in at 10% of tax on up to another $19,050. So if you take the $19,050 and plus the $24,000, that total is going to be $43,050, and on that you're only paying $1,950 in taxes, for which that equates to about 5%. So a married couple making about $44,000 would end up paying about 5% income tax for the federal government. So those are significant changes, whereas the old act was much more significant than that. I think we're ready to move on to business tax deductions. We spent about 20 minutes on individuals. Again, I'll summarize some of the major changes for individuals are going to be the real estate tax and income tax limitation. However, the alternative minimum tax has been exempt, has been almost eliminated. It's still there, but it won't impact many people. And of course, the tax rates, which are much lower than they were under the previous act, especially for those earning $400,000 and less. So after spending 20 minutes on the individuals, we would plan to spend about 20 minutes or so on the business side of things, especially on the pass-through tax deductions, and then we'll maybe throw in some additional things that may cover both individual and business, and then we'll open up for questions for the last 10 minutes or so. This is something that the pass-through tax deduction is something that most people are very excited about as small business owners. Largely, the questions that we are seeing from our clients and many business owners are, how can I make sure that I get this 20% reduction of my income, and what do I have to do to make sure that I get it? There are limitations, and entity choice is probably one of the most significant factors of this calculation. So that if a partnership, an S corporation, or a sole proprietorship are all eligible for the special 20% tax deduction. The rules are complicated with regard to S corporations specifically, because their calculation, once the income is above $315,000, there are going to be limitations based on wages paid and how that calculation is determined. Also, the industry for which a company participates is incredibly significant. For example, certified public accountants, so our CPA firm, is not eligible for the 20% qualified business income deduction and Section 199A because of our field and our specialty. Because we are licensed professionals, similar to doctors, attorneys, and others, in the healthcare field, this deduction is not allowed once our income exceeds the limitations. However, up to that point, we are allowed those deductions, and that's very helpful. So a lot of people think that they're planning on lots of opportunities, which we'll get into. However, as you can think about your company and your business, sometimes people want to buy equipment or spend money on infrastructure or advertising or other things as an investment, but they take the tax deduction this year or over the next few years, and then their income would be lower so that they would be eligible for the 20% deduction. So keeping all those things in mind, there is also self-employment and Social Security Medicare taxes. So a lot of times business owners ask if their income from their S corporation is subject to Social Security Medicare tax. And under the new act, nothing has changed. It's still the same as the old act, which means that S corporations the profit is exempt from Social Security Medicare tax. The income is subject to ordinary income tax rates. However, in higher income situations and in certain industries, the 20% deduction could be limited based upon wages paid in that company to an individual. So there's planning opportunities and planning situations with regard to the type of entity specifically. So the Section 199A qualified business income deduction is what we are talking about. So when you're talking to friends and relatives and other co-business owners, you can recognize 199A as a topic of conversation. Knowing that pass-through businesses, which are sole proprietorships, partnerships, S corporations, in general terms, are allowed this tax deduction. This is exempt for a corporation, so a C corporation would not be allowed this tax deduction. This law replaces something called DPAD, or the Domestic Production Activities Deduction, and that has been eliminated. In several calculations that our firm prepared, we recognized that the DPAD, the old law on 199, was about somewhere in the range between 4 and 7% of the taxable income for the company. The new act provides 20%. We think this is an increase of up to 13% from the old act. So 13% less of your income from the company, if things are planned properly, would be taxed, would be 13% less taxable income. Obviously, you would do that on the math, on the tax rates, and at the highest brackets, that 13%, you could save up to 37% on that reduction. And that's beyond the DPAD if you qualified for DPAD. Of course, DPAD was subject to a lot of different restrictions that now are made available to many other businesses. And so that the calculation for domestic production is no longer as important as qualified business income, again, which we will talk about. So non-professional companies, PSCs or personal service corporations with owner income under $315,000, again, we talked about that, is okay. So they will still receive that deduction. If you are an attorney under the $315,000 limit, then the tax deduction is still available on your pass-through dollars. So this next section is something of significance, and again, we discussed it, but there are limitations to the 20%. The deduction is limited to the lesser of 20% of the income or the greater of 50% of W-2 wages. So that means that if the company is not paying significant wages, the limitation, the deduction will be limited, or 25% of W-2 wages, plus 2.5% of the current year adjusted capital assets basis. So the asset basis, a lot of times for many small businesses, is zero because they've taken advantage of many of the accelerated depreciation rules. So then if that has happened, the service Congress has passed the act that says that your income would be taxed as wages versus pass-through income, specifically for an S corporation. As sole proprietorships, generally we would not see much of a reduction of that 20%. However, as a sole proprietor, again, you are paying Social Security, Medicare taxes, and local wage taxes in Pennsylvania on all of your income, not just some of your income. So some of the advantages to being an S corporation versus a partnership or a sole proprietor have been consolidated, and it's made more of an equal playing field for each of the entities based on the 20% deduction. So a lot of people that have been considering making a subchapter S election may reconsider and stay within the rules of their sole proprietorship. Other people, however, may be much better off filing a subchapter S election for their sole proprietorship and single-member LLCs. Single-member LLCs can be taxed as sole proprietorships or S corporations, depending upon an election that they would make with the federal government. Guidance pending for short years due to an acquisition or disposition of a company, of a qualified business, they're not out yet. So there's some opportunities that we will see occur that will come up during 2018 that will change the way short years are reported for tax purposes during 2018. There will be other probably amendments to the law as there are additional questions specifically regarding the definition of types of service companies such as consultants. So some of the rules that again we should look at is there are reasonable compensation guaranteed payments. These deductions are important in calculating our 199A deduction. So there are laws with regard to reasonable compensation, which all small business owners should recognize. Reasonable compensation is not defined generally in the code other than a compensation that is reasonable for the services rendered for the company. So in general terms, we would look at that guidance and suggest that business owners document their services to the company and try to find comparatives in their industry for the services that they provide to the company and compensate themselves based upon that statistical data. Similarly, the Internal Revenue Service has benchmarks for certain industries and certain individuals that provide services to companies and what their reasonable compensation should be. They will apply these rules in 2018 tax returns when they're reviewed in subsequent years. Having a discussion with your CPA about reasonable compensation is high on the priority list. Again, one of the big takeaways, hopefully, from this call would be to review reasonable compensation and also then guaranteed payments as they apply to partnerships in regard to the new Tax Act, and specifically with regard to 199A, the 20% tax deduction. This is something that we don't want to miss for any of our clients. We want every small business to qualify for the 20% 199A deduction. However, many, without good planning, companies could find themselves not being allowed to take the deduction. So the burden would be on the taxpayer to seek out proper guidance and make changes within their company to be eligible. But again, all of those changes cannot be driven by tax savings as much as they would be driven by reasonable and economic terms. However, just like we talked about earlier with individuals, The reimbursement plan for employees is something that would be a change in business, but it would basically be a change for the better for everybody, and it would be some economic merit to those decisions. So generally speaking, we would not suggest business owners or individuals make decisions based just solely on tax and tax reduction. However, you should apply economic reality to all of those decisions. So there's a couple other things which I won't get into too much, other than real estate investment trusts, which are REIT, and publicly traded partnerships are also eligible. So there was a significant change in the tax code under 199A that allows passive activities and real estate companies to enjoy the benefit of a 20% deduction from their income as that income passes through to them individually. This is, again, it's subject to many rules, and specifically qualified business income is one of those rules, which we'll get into. This page summarizes an example, a completely made-up example of how a calculation would work to determine qualified business income and the tax benefit of a particular company. So, in this example, the ordinary K-1 income from an S corporation, and this was an S corporation, this flows through, and then a tax deduction is determined that the 20% deduction flows through to calculate $139,000. However, it is limited to the wages, 50% of wages, which we have in the next box, and that is $107,000. And so when we do the math also on the 2.5% of assets, we get limited further to $59,743. All of those things factoring in, and we look at a net savings for the qualified business income tax deduction under 199A at $107,392 due to the two-tier factor of the 25% and the 2.5% qualified business assets, which allows the $107,392 as our tax deduction. So if you look at the lower left section of this spreadsheet, you will see a number, hopefully it shows in red on your computer, $107,392 as a tax deduction, and recognizes savings of, on the far right in the box, of $39,735. This is quite important and quite life-changing, especially when you consider if you save $39,735, and then as a business owner or a partner in a company, if you're able to take those tax savings and then perhaps contribute that money to a retirement plan, you would save an additional, in the tax brackets that we're looking at here, which you would be at the highest, close to the highest bracket at 37%, potentially, it depends on your other income, but that savings would be an additional approximate $15,000, almost $14,000 of additional tax savings for contributing that extra savings in tax dollars to a retirement plan. And so if you have extra cash flow, that's one thing to do with it, instead of using it for vacations and other things that you might enjoy. Sometimes taking additional savings can reduce the time that you would need to work in your life to get to financial independence. So this calculation can be reviewed, and you can use this spreadsheet in your planning opportunities with your particular business, and hopefully everybody will recognize this tax deduction and enjoy the benefits. So this is an example of a tax advisory firm. Of course, the income is way too high because tax professionals don't make near that amount of money. But we'll use this example anyway. So assuming that the individuals have wages from an LLC, and then they have pass-through income of the amount of $99,842. You can see where the 199A calculation will impact them and allow, even though they are a licensed professional and the limitation exists, they would still save over $4,000, almost $5,000 in tax savings from the 199A under the current law. Again, being prudent savers, if they were able to take that $4,793 and contribute that to a retirement plan, there would be additional savings on their taxes up to an additional 24% on that extra money, another $1,000 approximately, and again, recognize no difference in their take-home money to the household. So those are the kinds of things that the 199A can do. Again, it's somewhat complicated. Hopefully, we've covered a lot of that today. I'm going to take a 2-second break and go to the next slide. There are some other very significant business changes, specifically with regard to C corporations. And we're also going to talk about accounting method, and we're going to talk about some areas of the law that have been clarified in the Tax Act. And also we're going to talk about depreciation, which is one of my favorite things. I know it sounds like I'm a geek, but I do love depreciation. It's one of my favorites. The first slide here talks about corporate income tax. This is significant for C corporations. Also, there's no longer alternative minimum tax for corporations. So corporations have a flat tax rate of 21%. This is incredibly significant for companies that have been operating overseas and now wish to do business more in the United States. That would encourage them to do so and to bring factories and other large facilities into the United States, because the tax rate is now average for the rest of the countries around the world. Instead of being the highest tax rate for corporations, we are now one of the middle countries. The property and assets, this is a section that I admittedly love, and one area of the tax law that has been used by many of our clients and many other clients is Section 179. Section 179, most people recognize as an ability to depreciate an asset very fast, up to 100% of the cost of the asset. These laws are now expanded, and your limits are much higher, up to $1 million. And then there's also additional 168K depreciation. So when you are purchasing assets, it's important to recognize that your depreciation is much greater than it was under the old Act, and it will continue throughout this Tax Act until it's changed. It does expire and sunset in the year 2022. There are some limitations back to the old Act. So these are temporary laws with regard to limitations. One thing that's very significant also is that luxury automobiles, that depreciation has been expanded so that a luxury automobile is depreciated much faster than it was under the old Act. This is good news for people that like expensive cars. There's farm business depreciation that is now a 5-year period, so that has been reduced from up to a 15-year period to a 5-year period. And for certain real estate, also, we are going to drop from a 39.6 or 39.5 depreciation years for commercial property down to 27.5 and potentially lower for certain improvements. So we're going to talk about that and planning opportunities. One other thing of very importance to note, and this is again something significant, I'm going to say it 2 times, net operating losses cannot be carried back under the new Act. So again, net operating losses would not be eligible for carryback under the new act. They would be allowed to be carried forward, however, and limitations are not set on the carry forward laws. Very interesting piece of the act. So they've effectively made depreciation to a point where you can deduct most things that you purchase 100%, other than certain vehicles and personal use vehicles. However, you cannot, if you create losses for your company, significant losses, the government has stopped the opportunity for going backwards into 2017 and 2016, where the tax rates were much higher, and getting refunds. That was used for many small businesses, especially in a startup and growth mode, that they would incur large losses and then do carrybacks and get refunds. That has been stopped. So that's a very important thing to recognize because those questions come up. Should I go out and buy $1 million piece of equipment and my income is only $500,000 and I have a $500,000 loss and I'd like to get all my money back from 2016 and 2017? Great idea. Congress thought about that and they said no. There is now compensation. There's exceptions to the $1 million deduction limit. That has been repealed so that companies, these are for large C corporations that were paying stock bonuses, and there were limitations on that. Again, keeping businesses from wanting to do business in the United States because that was not similar to other countries. Now this has been repealed. One fun thing about the act is that penalties and fines, there is now a requirement for the government to tell taxpayers when you're paying a fine and a penalty, whether it's a portion of that would be deductible or not. So the government has some reporting responsibilities. If you paid large fines in prior years, the government would not necessarily disclose the application of tax deduction for that, restitution payments, for example, and then a lot of times those would be determined in a court of law. However, Congress with this act said that no longer should a taxpayer go to court to determine whether that would be deductible. That would be done with a settlement, perhaps with the government, well in advance of a court date. So that is something significant. One other huge planning method is that the tax law has expanded the use of the cash method of accounting, where it used to be that businesses over $1 million in the retail world and up to $25 million for service businesses would be required to convert to the accrual method of accounting, which requires business owners to pay tax on their receivables minus their payables. In general terms, there are many other implications to that. That's a simple example. However, cash and accrual accounting should be looked at by every business in 2018. You should look at that with regard to the new Tax Act and how it might impact you. So we are going to talk a little bit about planning and strategies. To summarize, we are about 15 minutes out to our termination point of the session, and I do want to leave about 10 minutes for questions. So just to summarize, with businesses, we talked significantly about 199A. I hope that everybody listening recognizes that 199A is built for small business. It is built for pass-through businesses. It is built also for larger businesses, real estate businesses, any business that passes through income may be eligible. However, there are many limitations, as we talked about, that may reduce that deduction, and those need to be planned during the year by the taxpayers. We also discussed how the accounting method for a small business, as allowed by the federal government, has changed and has been expanded to further use of cash method is allowed. However, accrual basis accounting sometimes is a better method of accounting for small businesses, and that should be reviewed. One other thing that is very interesting that we've noticed is that mergers and acquisitions activity has been extremely prevalent. We think that because the corporate tax rates are so much lower, that other large corporations are now using those dollars in tax savings to go out and acquire smaller businesses. Chances are, if you own a small business or work for a smaller business, that company will be a target to be acquired. A lot of times that may be a very, very good thing for the employees of a company and the owners of a company, but it's not to be looked at without a lot of guidance and support. So just recognize that M&A activity is, because of this new tax act, we think is going to be much more prevalent, and there'll be a lot of people interested in buying small businesses. The depreciation rules we talked about, and again, of significant note, the caveat that carrybacks of losses would not be allowed. However, planning for depreciation would be a very good thing. As we wrap up our talk with regard to certain, before we open up the questions, the one thing I would suggest is that as a business owner, you would control depreciation. When you review the Tax Act and review the rates, which I'm going to go back to and show right in the beginning, when you look at your business, and if you are somebody in a business that would make an average of $315,000 or less, chances are you would like to set your depreciation so that your income would be somewhere, taxable income would be maybe perhaps around $77,000 or less to stay in the 12% bracket. If you see that large jump from $77,400 of married filing jointly taxable income from 12 to 22%, that is the largest jump in the tax rates. So there is the opportunity right there for everybody from a depreciation perspective to try your best to stay within the 12% bracket using depreciation as your asset, as your ally, and your tax planning professional to manage your income so that you can stay within the lowest bracket of the law and reduce your taxes so you can reinvest into your company, reinvest in your retirement plans, and reinvest into your future. So at this point, hopefully you have enough about the new Tax Act to think and to plan. There are many, many parts of the Tax Act that we did not go into. However, at this time, we would like to open up for questions, as long as Christine is okay with that.
Yes, questions are wonderful. In fact, I've been getting a couple of questions through the chat room. So the first question we have, David, and I think a couple of people have asked me this, are the slides going to be available? Would you give them to us so we could email them to those who are listening?
We would certainly do that, yes.
Okay. Second question, in terms of second residence mortgage and the interest, is there anything new there, anything that you can talk to us about?
Second residence, again, would be allowed only under the $750,000 limit. So there'd be total mortgage interest for first home and second home. Okay.
And then another question that came in for S Corps, and when we talk about the $315,000 limit, does the owner wages and profits combined determine that $315,000 limit?
Yeah, that would be, that $315,000 is taxable, total taxable income. So that's determined as your total income. So not just the business income, but your total income. So that's a calculation on the individual return, and not so much on the business, but it's as the pass-through. So if that answers the question, you're going to combine both, I think was the question, right? The wages and the K-1 income in order to determine
right.
The limitation. Again, that's only a certain industry, so recognize that if you're in manufacturing or construction or anything like that, that limit would not apply. You're going to get that deduction regardless of your income. That's only for professionals and consultants. However, consultants is an area of the tax code that is not yet defined, because there's been a lot of questions about that. So there'll be some more guidance about consultants specifically.
Okay, and then our next question, a couple of people have asked this. Can you talk a little bit more specifically about the rules of small S Corps and how they can plan to get that 20% deduction?
That's a great question, and I think these two slides, which again we will make available to people, is where we would want to spend some time with a business owner, and you can do this on your own. But if you work through these calculations, you'll see the limitations, and then it'll leave you probably with a lot of questions as to what is the amount I should pay myself to maximize the tax savings. Again, we would suggest that that answer is also, it's important to recognize what is the reasonable compensation that I should be paying myself, not just how can I save the most amount of taxes. So those things should be answered together into a combined calculation and determination. And of course, we strongly recommend, and the IRS would require, that reasonable compensation for business owners to be documented. So we think that there should be some effort with Subchapter S corporations specifically in documenting why and how they would pay themselves a certain amount of wages. Sometimes we're recommending putting that in your annual minutes, and in other ways you can document it as well.
Okay, great. And then we have a question: would a mortgage interest on rental property be impacted?
That's a very good question. We did not cover a section of the law that limits interest as a business deduction in certain situations. So if you have a large amount of debt on a piece of real estate, that interest could be limited based upon your rent. So if you have very low rent and you have large interest, that interest could be reduced. However, there's a lot we didn't go into, and we could maybe follow up with that individual later on that. I don't want to spend a lot more time on it, but yes, it's a good question. Generally, it would not be impacted. However, in certain situations where the interest is extravagant, it's very large, and the income is low, there are limitations.
Okay, and we can give you that person's name. Let me see here. In terms of equipment and truck purchases, what is the maximum for the I-179? Does that make sense?
Yeah, the equipment and truck purchases. And those let's see, I will, hold on one second. There's two different sections of the code. There's 179 and 168K. And there's a $2.5 million purchase limit on 179, which then goes to a $1 million depreciation limitation on the total assets being purchased. So that's one of the limitations. There's also the 168K allowance, which allows, it really, I think there are not limits on the 168K. So that is 100% for the current years until through 2022. So bonus depreciation is quite significant. Now, the difference is what is eligible to be depreciated under 179 and 168K. This is very, very significant, is that it used to be that only new property was allowed under 168K, and now used equipment is now also eligible for that bonus depreciation. So generally, the cost of equipment that you purchase would be 100% allowed either under 179 or 168K. Again, the planning suggestion is that if you buy $1 million piece of equipment and you only have $500,000 of income, if you get to negative 500,000, you're not going to be able to go backwards and take those losses to prior years. You would be able to carry it forward. Sometimes we're suggesting that you also look at state laws and state income taxes with regard to those depreciation rules, which Pennsylvania has not adopted, the 168K or Section 179 only up to 25,000. So you have to look at that and how this would impact your tax rates going forward. So for example, taking a large deduction this year may get you in the 0% bracket, but then next year your income is in a 37% bracket. We would suggest that maybe you would try to straighten that a little bit over the next 3 or 4 years to a point where you're staying in the 10 to 12% bracket, in the 12% bracket, if at all possible, over that period of time, versus going from 0 to 37%, which might cost more money in the end. So generally speaking, the rules for depreciation are expanded so that you can deduct 100% of your equipment. There are certain rules for real estate, which again, I don't really have time to get into at this moment, but there are a lot more opportunities for real estate, especially with regard to improvements and segregating your assets in a real piece of real estate is now more important than ever.
Okay. And we do have many questions that are coming in, and I know we're coming to the end. So I'm thinking we'll take a couple of more questions, and then at the end of your slide, do you have a way for people to contact you if they want to get more information and talk to you about all of the changes?
Yes, and okay. We would maybe attach that to the slides and provide that so you can get it out to everybody, Christine. That's very kind of you.
Okay. So our last question that we'll take here is, is there, through any of this that you've talked to us about today, is there a reason for a small business to maybe look at LLC versus S Corp versus C Corp? I think that's
the answer to that is yeah, it's a really good question, and yes, the answer to that is all yes. There are certain situations that an S corporation would be much better from a tax perspective, also from a business perspective, but largely, we would recommend that you make that decision not so much 100% geared towards tax, but also towards the long-term transition of your company. That should be part of a planning opportunity with your tax professional to think about the long-term impact, meaning would you want to hand the business to your children or heirs, or would you like a sale at some point in the future, or do you want to bring some employees on to be business owners with you? Those are all decisions that are important, and they impact your entity choice as much as tax. So we would not suggest just to do a tax calculation only. Look at it as a complete business decision, and then hopefully that gives you to the best option for the business owner.
Okay, and I know I've worked with you with several clients, and that's always the big question, and that's never an easy answer. Like you said, you've got to look at all of the different variables. So I want to thank you, David. It's been wonderful. I mean, when you and I talked originally about the federal tax laws and some of the changes, I didn't realize that there were so many and some of these things that are so important to our small business owners. So thank you again. I'd like to thank everybody who came on the call. I think that we've recorded it, so we should have a recording of this that we can send out to you along with the PowerPoints that will probably come to you tomorrow. We also have an evaluation that will come to you by email, and it's really important for you to fill out that evaluation to let us know in the future what kinds of things that you're looking for us to do in terms of webinar, and then how you felt today's webinar was. So thank you, David.
Well, thank you, Christine. We just hope the best for individuals and small business owners, and we appreciate being a part of the Small Business Development Center at Duquesne. Thank you so much.
Thank you.